everyone, this is Charlotte, and I hope you're doing great. I'm just stopping by to say hello and to remind you that UIC's annual Christmas fundraising banquet will be December 14th, 2024, starting at 5 p.m. This year, our location will be Summit Kingston, formerly called Knutsford Court Hotel, which is at 11 Ruthven Road, Kingston 10. As you may know, UIC Jamaica is 100% committed to good governance and aims to unite, liberate, and empower our people. If you desire to see Jamaica become the paradise it should be, clean, safe, beautiful, and orderly, then your contribution of 10,000 Jamaican dollars or 65 US per adult and 5,000 Jamaican dollars or 35 US per child will help us to provide a new leadership, a new system for a new Jamaica. We promise an evening with lots of fun, lively entertainment, great speeches, and delicious food. While it would be my greatest desire to see you all in person, I know some may not make it home for Christmas, but your donation will give someone less fortunate the opportunity to attend. Thank you so much for taking part in helping us to educate and work with our citizens to restore and in some cases rebuild our beautiful country. Here are your options to purchase your ticket. You can go to www.uicjamaica.com and pay online, or you can send payment via Western Union, MoneyGram, Zelle, Cash App, or bank transfer. Call 876-293-0812 for additional information. To RSVP, you can email us at info@uicjamaica.com, or you can WhatsApp us at 876-293-0812. Thanks a million for making this possible. One Jamaica, stronger together.
Well, it appears as if you couldn't hear me, could you? No audio. All right, I think you can hear me now. I'm sure everything should be okay now. Thank you for your patience there. So good evening and welcome to all of you. Let's talk about investing, and we're going to include crypto or Bitcoin in the mix. Remember to like, share, and subscribe for more content like this. And do not hesitate, do not be shy to write down your questions, comments, or feedbacks. Your input is very important to us so that we can serve you better. I'm seeing quite a few people on already. Juliet, always early. Christopher Lawrence, Norman Clark, Alex, Kirk, Miss Barrett, who else I'm seeing here? Quite a few people. Welcome to all of you. All right, so we're going to get into this topic. It's one of my favorite topics because I love to explain to people how they can actually do far better than they might be doing right now. It's one of those weak areas in our school system where it doesn't really prepare us to understand or manage money effectively. So I have been very, very fortunate to have taken the time over the years to study the subject deeply, and not only to study the subject, but to apply that knowledge in so many ways. I'm not your typical accountant. You know, some accountants are just bean counters. They just count how much come in, how much go out, is it properly classified, and they meet all the audit requirements and all the tax requirements, and that's it. I've never made that side of accounting my full stop. I have expanded my accounting knowledge to really embrace finance and economics, investing, personal finance, corporate finance, and expanded that into, business in general, understanding business from top to bottom and so on. So over the course of my life, I've, been able to try different things and see the outcomes, learn from some masterful investors like Warren Buffett. And 1 second here, look like I'm getting some advice. Okay, cool. Yeah, so I've had the privilege of really digging into the subject. So tonight I want to share some of what I've learned with you, and over the course of several weeks we'll go into more and more. But first I have to make a disclaimer that this is not financial advice. The government only wants you to hear from and to do what their approved financial advisors tell you. This is to ensure that you do exactly what they want you to do and that you get the results that they want you to get. So please do not consider anything I say here as financial advice. I'm just sharing with you my own experiences, my thoughts, and consider it coaching, motivational, inspirational, if you will, and then you can do what you want with it. But most importantly, the government wants you to go to a licensed financial advisor and to take their advice, because they have been programmed to give you specific sets of instructions and options and to make sure that you follow that. So tonight, I'm not going to be advising you. I'm just going to be sharing with you. And feel free to ask me any questions or, make any suggestions or comments as we go along, and I'll try to respond to some of them from time to time. But let's kick this off by asking ourselves, what is investing? What is investing? What does it mean to invest, really? Now, if you take the word to its full meaning, investing is deciding where to allocate your time, your talent, and your resources, be it financial or otherwise, with the expectation of achieving a desired positive result, right? Or return. So investing can take many forms. I mean, when you were going to high school, you had to decide how to allocate your time, what you're going to invest your time in. Some people invested time in sports and recreational activities or fun, and not so much in studying, and they got the results for that. Some people in their adult years decide how they're going to spend their money. For example, a person may decide that they want to drink a lot, they want to smoke a lot, they want to womanize a lot, and that's how they have invested their money. So the return on that is whatever immediate enjoyment or gratification they got, and then the subsequent years they pay the price for that kind of investing. So investing is really just you deciding how you're going to spend your time, your talent, and your resources, be it financial or otherwise. Now, I believe the number one investment that you can ever make is, and it's very important that you understand this, the number one investment you could ever make is in yourself. That's your number one investment. And if you mess up on that number one investment, everything else that I'm going to say here tonight will be less than helpful to you, because that number one investment kind of affects all the other things that you do. It either boxes you in or it expands your horizon and give you more options than others who do not make that investment. And so, of course, your parents have been trying to get you to invest in yourself from you were a child. They would say, learn to read, learn your time stable, and so on. Those are basic investments that you need to make. And then, of course, you need to build on that. one of the unfortunate thing with human beings is that after they finish school, they literally stop learning, or they learn casually. They're no longer focused learners. They're just kind of by the way, kind of pick things up as they go. So they stop learning at a level that is required for them to be able to invest, effectively. But your first investment is to invest in understanding yourself, understanding who you are, understanding how your mind works, how your body functions, what kind of personality do you have, and your inherent biases, because we all have inherent biases depending on where we came from, what culture we came from, what was our family life like, in our house, what kind of ideas were being espoused by our parents. So a child who's in a home where the parents are generally spendthrift, that's what you're going to be normally, unless you take a conscious decision to not be a spendthrift. You're going to be more careful with your money. A child who is born into a home where the their parents are always trying to save money, they're going to have typically those kind of traits as well. And while that is a good trait, it has some downsides as well, because you have to save in a particular way. Just saving alone can be quite disastrous, because inflation is a serious problem, which is going to wipe out your savings. So the first investment you can make is really understanding you, and that's critical. And the next investment is to understand people. Now, this is very difficult because most of us didn't study psychology in school. And even if we studied psychology, we may not have studied it in a way that allows us to look at people in the full extent of the world of investing. So you want to understand human behavior, how human beings generally think and behave. You want to understand family, because oftentimes people make huge mistakes by putting too much confidence in family. For example, if you're running a small business, you might decide to bring in your family members to run the business, but that might prove to be detrimental for a number of reasons. It's very hard sometimes to work with family in a business setting if they're not mature enough to understand the difference between when you're being family and when you're doing business. And you'll have conflicts there, and it will actually destroy the business. So you have to understand human behavior, understand family relationship, and then understand friends, and know where to compartmentalize each of them, or you might have some serious problems. You have to also understand how to design business relationships. Sometimes, for example, people go into business and they say, let's have a 50-50 split. That is not necessarily a wise thing to do. And I'll, walk you through that. Let me tell you about it now. I was going to save it for another time. But when you enter into business with somebody, you have to really understand, what is this business? What is the role of each of the persons, and what role are you going to play in this business? Suppose one of you is particularly skilled in marketing, and you assign that role to that person. Another person in the partnership is skilled in accounting, and you assign that. Another person is skilled in sales, so you assign that. Another person is skilled in operations. And let's say you decide to split the business evenly between all of those persons. What is the rationale for that? Are they going to bring the same level of intensity and work ethic to their share of the business? And are each of those roles really equally balanced? Wouldn't it be wiser if you design the business so you compensate each person for the skills they bring, separate from how you're going to divide the profits of the business? So the profits would be divided based on capital invested. So let's say two of you put in 60% of the capital, then 60% of the profits should be going to you, because you're risking 60% of the capital. But in terms of each person's competencies and workload in the business, you're going to compensate that as if you would compensate a staff. Now you're creating equity. So there's an example of understanding business relationships and how to design it that would give you maximum, outcome, as opposed to, doing it the way most people who are inexperienced on and not really au fait in this area would just kind of have this 50-50 split or this equal split, which is not practical and will create problems down the road. You also need to understand the market that you are operating in, and you have to understand market in the context of that markets are just people. When you hear the news talking about the market did this, the market did that, you may misunderstand that to be something other than what it really is. Markets are simply people making decisions. Markets are people making choices. And so all the people you see and those you don't even see in a particular space in society, once they're buying or selling that product, they constitute the market. So you can have a market for wheat, a market for cars, a market for homes, a market for toys, a market for groceries, a market for gas. So you have to understand when you're talking about markets that you're talking about people. So if you don't understand human behavior, and if you don't understand relationships, then you cannot properly understand markets, because you might think of market as something other than people making decisions. Once you understand that markets are people making decisions, you can then look for the incentives which drive people. And when you understand those incentives, you can now effectively make investment decisions, because you know what are the likely outcomes if this factor changes or that factor changes, or this new products come to market, or this particular law is passed, or this particular person is elected. So you're now in a much stronger position if you have invested in yourself to make sure you understand you. So you understand your emotions, you understand how you think, you understand your biases, you understand the people around you who you're working with, you understand the broader context of investing, which is the market, people in a particular industry making decisions. And then finally, you have to understand money. And last week, I began to share with you a bit about money. We talked about, what is money? We talked about the characteristic of money. We talked about the key components of money, and how money versus currency work, and why it's important for you to keep an eye on, fake versus real money, and what it does to, the economy in which you're operating. So having said all of that, I must reiterate that investing in your knowledge, your intelligence, your understanding of you, people, and markets is critical. And then you have to understand how money works, what is it, how it works in terms of inflation, how to account for it. Yeah. What is finance really? What are the elements of finance? How to go about financing? How does financing work? Understanding taxation, because taxation is a big part. You can do an investment, and the investment by itself is very lucrative, but when you factor in the tax component to it, it becomes unprofitable. So you have to understand the taxing regime and how that will affect the investment. You also have to understand economics. Economics really is the study of markets and how those market interacts according to certain basic laws and rules that economists have come to generally understand to be true. Now, of course, you have to be careful, because there are different schools of economic thoughts, and you have to make sure you pick the right one. I have chosen the economic school or thinking that Milton Friedman would follow, because that I find to be the most effective way of looking at the economy. And so far, it has not failed me on any decision I've had to make. So before you make any big investment decisions, check yourself. Make sure that you have spent some time investing in you. And this program that I'm doing now, and which will be going on for a number of weeks, is geared towards giving you that greater financial intelligence, which you're going to need to make wise investments. So our goal here is really to help you to become, wiser in all that you do. Sig Sire says Bitcoin has lots of downside risk when it's at all-time high. We're going to talk about that. And Sig also says start your investment in blue chip dividend stocks. Okay, so it's giving you some advice here. We're going to see if that's the best advice can be given. And the Easy Jerk World TV says I am 10 manners and respect at UIC at Mr. Patterson. All right, thank you so much for that. Welcome, Craig McKenzie. I see you on as well. And Director Janet, I think. Welcome to you all. So I want to touch on something very important before we go into the other pieces now of our, let's call it our study today. Your greatest investment risk is actually you. You know, sometime when you're doing investment, people are looking at how risky is the investment. Investments are not necessarily risky. The degree of risk in any investment is you, how knowledgeable you are, how much or how little do you know about this particular type of investment. You know, the least you know, the higher the risk. The more you know, the lower the risk. So if you are doing any form of investment and you know within yourself that you don't know what you're talking about, you don't know it, don't pretend. Don't just borrow the words and phrases you hear on television, you know, or you hear people talking about. Just check yourself really and say, do I really understand this? And if you don't understand it, the risk is this high. If you really understand it and know what's going on, the risk is this low. So for example, let's say you have spent many years working in the restaurant industry. You worked in that field. You helped to serve customers. You cooked food. You helped with cashiering. You dealt with stock taking. You washed dishes, whatever. And then you took the time now to go and do a little bit of reading about how restaurants work in terms of, you know, the cost structure, the revenue model, the loss factors like, you know, waste and so on, spoilage. You understand location and so on. So you've spent some time on it. So you know quite a bit about the restaurant industry. It means if you're going to do an investment in that industry, you are far more prepared to do that investment than somebody who knows little to nothing more than have a general vague idea of restaurants because they went in and had meals at a restaurant. You need more than that. And if you know more than that, then you're in a better position to invest than somebody who doesn't. So remember, the greatest risk is really you. And you can diminish that risk by making sure you truly know and understand the investment that you're getting into. I hope that's making sense for you so far. Lentford says, I'm happy to be here. Good to see you as well, Lentford. Duffus, thank you so much. And Janet says, I'm always looking forward to learning from the best. You're very kind. Thank you so much. So now we're going to move into another segment, which is understanding why savers are losers and investors are winners. Now, inflation, taxation, and impulse spending are our greatest enemies. We have been taught as children, I don't know if you remember back in the day when you were in primary school, the banks came to your school through some nice lady or nice gentleman, and they encouraged you all to go and sign up for a bank book, and you were all encouraged to join the Savers Club, and you were putting money in these accounts. You were encouraged to do that. Does anybody remember that? Is that something that happened at your, primary school, maybe even high school, where they came around and encourage you to get a savings account and to start saving? You might remember that. Now, I'm sure when they were doing that to you, and as they did to me, they never simultaneously explained to you the concept of inflation. I'm not going to get into the technicalities of inflation tonight because I've spoken about it before, and we will speak about it again. But inflation is critical. Anybody who simply tries to save money will lose, because every single day the value of your savings is going down by design. That's how the system is designed. It's designed for you to lose the value of that money every single day. The government will actually tell you that they have a targeted inflation rate. In Jamaica, it's about between 4 and 6%. So they're telling you that every single year they're planning to steal between 4 and 6% of your money. So if you're saving, you're losing 4 to 6%. The bank is also taking bank charges and fees out of that, so you're losing more than 4 to 6%. And the truth is, inflation is generally much higher than the quoted figure. So if they're telling you that inflation was 5%, that's an aggregated number across many, many different products and services. But in the space where you live, in terms of your rent, in terms of your grocery and gasoline and so on, inflation may be running at 15, 20, 30%. So it means that little money that you're saving is losing its value at, the speed of light, really. I mean, just kidding, but it's really losing its value very fast. So you're not getting anywhere by saving. Saving by itself is a losing proposition. You're losing money every day you put money into an account and say, I'm saving it. You're losing big time. Investors, on the other hand, they're winners, because investors, real investors, understand this and know that they have to make that money work for them. That money has to be working. It has to be working to overcome inflation, to overcome bank charges, and to overcome taxation. So investors are winners because they understand this and they're looking for ways to invest. And if you're not an investor, you're a loser. Geez, that sounds horrible. I feel bad saying it, but it's true. If you're not an investor, you're a loser, because you have to lose. All you're doing is going to work, getting an income, buying food and shelter and clothing, and trying to survive. And any money you have, the value of it is depreciating every single day. So you're losing not because you are a bad person. You're losing because the system is bad. It is designed to steal your money by using fake money instead of real money, like we discussed last week. You're using fiat currency, not real money. So fiat means fake. You're always going to be losing. Yeah. So the government is designed to rob you through inflation and through excessive taxation, and the bank is designed to rob you through the various ways it takes away your money while being able to lend out your money or a multiplier of it because of the banking regulations at much higher rates than it will ever give to you. So you can't trust the bank, you can't trust the government, and you can't even trust yourself because you don't know anything, you don't know enough. So to overcome all of that, you have to invest in your knowledge and build your knowledge setup. And then you have to stop being a saver and become an investor. And for you to do that, you need to do all of them about to say after this. Yeah. So bear in mind, again, inflation, taxation, and impulse spending are your greatest enemies. You don't even see them because you're just living. So every day that you're walking around, inflation is eating away your money, taxation is eating away your money, and impulse spending, meaning you're just spending without thinking. Spending is a normal, satisfying part of human life. We love to spend. When you spend, you actually feel good. So you have to kind of work in a way. Remember earlier I said you need to understand yourself? This is it. So if you understand that human beings love to spend, we feel good when we buy something. So now you have to play a game with yourself. To satisfy your urge to spend, you want to set up a mandatory investment savings plan. So a plan where you're saving, but you're not just saving, you're saving to invest. Okay? And you want to make it kind of mandatory for yourself. So you're automatically or you're regularly doing this on a cycle that you're not going to get off for a long time. So you keep putting money in and it's an investment, and it's building over time for you, and you're doing it almost automatically, if not automatically. That's one of the reasons why we created the Community Capital Club, because this is a great way for people to get into an automatic saving for investing plan. You're saving, but you're doing it for investing, and you're fighting against your greatest enemies: inflation, taxation, and impulse spending. If you take that money out of your hand and put it into something meaningful, then you're not going to impulse spend it anywhere else. And you're going to feel good when you go back and check on it and see how it's doing. You're going to get the same feeling that you would if you had bought one more ice cream, one more burger, one more shoes, one more trinket, which you probably didn't need. So set up an automatic investment vehicle that is automatically saving and investing at the same time. And for that, we have designed for UIC members the Community Capital Club. Hope that makes sense to you. Now we're going to talk about budgeting. Yeah, but before I do that, let me see what's in the comment here. Janet says, goodness gracious, you are right. Bad system with fiat fake money. And Janet says, this isn't taught in college. Absolutely not. They wouldn't want to teach you this. If they taught you this in college, more of us would be wealthy. And you wouldn't have 1% having all the wealth. You would have like 80% of us being wealthy or near wealthy. You'll always have some people who just love to be losers. They'll make bad decisions just because. But if they taught us well, the same way we have bad practices because they taught us bad ideas, we would have had good practices because they would have taught us good ideas. So now we have to do it ourselves. We're going to teach ourselves and overcome all of that. So Sister Janet says, we have to invest in the right products, though. Absolutely. And Monica Richards says, yes, for investments. Now there are tax-free savings accounts, but most savings accounts, you do pay fees on withdrawals and tax at the end of the year. All right, so let's continue. I want to talk about budgeting. I'm sure all of you have heard about budgeting, and all of you have tried to budget. And oftentimes it ends in dismal failure. Correct me if I'm wrong. Most people cannot budget. They will try. And the way they teach you budgeting is very, very painful. You know, you have to write down all of the stuff, keep tab of all your receipts, see how much you spend against entertainment, how much you spend against, grocery, how much you spend. And it's so tedious because it's a lot of bookkeeping, right? And you're trying to gather all the data, and you're trying to track it and see how you're doing against all the budget lines. It's not a bad practice. I mean, I have done it, and my wife will tell you I drive her up the wall. You know, the early part of our marriage, we've been married for 30 years now, and one of the secret to remaining married for 30 years is learning how to adjust to balance the relationship with your partner. Again, it goes back to the first principle, learning to understand yourself and understanding other people, right? And understanding money. So with budgeting, you can drive yourself insane trying to budget. It's a very, very simple but annoying and painful process that will turn off anybody except an accountant. So I'm an accountant, so I enjoy budgeting. And for my family, I did budgeting for most of the first, I'd say 10 years. And my wife hated it. Not that she didn't want to budget, but she just thought I was too much, man. I was just like really too much on this thing. I have my spreadsheet and I'm monitoring every dime, every dollar. It became insane. So Janet says, yes, she's a witness, and Daily Happening says, true. So budgeting is something to really think about. And here's what I've decided, and it has worked for me and many others. You only need to budget once, meaning, or once every now and again. So what I did, and what I encourage everybody to do, is to sit down and look at your finances. And what you want to figure out really is, based on your income, right? Whatever your income is, how much of that can you live off, and how much of that can you put aside as savings for investing? And you just want to find that number. Then after that, you can throw away the budget sheet, right? You just want to decide how much you need to live reasonably, and then automatically save the difference in an automatic investment vehicle after paying off your higher your higher interest rate loans. So let's say you have some loans outstanding. If you have loans outstanding where you owe money to people, various interest rates, your first goal is not even to save. Your first goal is to pay off those loans if they're unproductive loans, because there are two types of loans, right? There are productive loans and unproductive loans. A productive loan is one that is producing more for you than it's costing you. So it's giving you more value than it's costing you. That's a productive loan. An unproductive loan is a loan that is giving you no value anymore, but it's costing you. So every month you're paying interest on this thing, but it's not giving you any value at all. It's not bringing you any more money. Get rid of that loan. So your first goal in terms of whatever you're doing with your life is to say, okay, how much of my existing income can I sacrifice to get rid of these loans? And then once you get rid of those loans, don't stop there. Take that savings, and now you're going to put that savings into investing. So you're going to continue to pay that into investing, and you're going to build up from there, right? So as I said before, you don't have to do this continuous budgeting. Just find that number that you can save. That's all you want to find. So you're going to pay your phone bill, pay your car payment, pay whatever you need to pay, whatever. And here's the amount that's left. You're going to make it happen, right? If you don't make it happen, then it's not going to happen. So you're going to have to say, listen, I want to get to a place where, I can put aside this amount for this purpose. And then, figure out how to make that happen within your existing configuration. And then you work on that and make it habitual and as much as possible automatic. If you're doing that, you're really getting ahead of the game here. You're getting in a much better position to become financially free in the near future. So what you want to do here is to save to invest and never borrow to consume. And that's one of the biggest problems people have who are not financially solid. They borrow to consume and they do not save to invest. Borrowing to consume is actually suicidal, because what you're doing is you are borrowing money which you're going to pay interest on, but you're not getting any future benefit from that loan. You get a one-time benefit of being able to, let's say you took a vacation and you borrowed to take that vacation. So you consumed all of that borrowing for the 2 weeks that you were in the Bahamas, and you had the greatest time of your life with your friends. You were so happy. You drank, you ate, you danced, you had a good time. And then when you're finished, you have a debt to pay back. The value of that debt is gone. You have eaten it. You have entertained it away. You have enjoyed it. There's no more value to come. But now, for the next several months, you will have to be paying back that debt that is earning you nothing. That is a foolish and a very bad debt. A good debt, on the other hand, goes something like this. Let's say the same amount of money that you would have put into this vacation, you put that money into something that's going to earn you, let's say 5, 10, or 15% on your investment every so often, whatever that period is. So the longer you have this investment going, you're getting some more money on top of that money you would have spent on that vacation. It keeps adding up, and it's compounding and it's compounding, and it's doing very well. That is a good debt. So the debt is costing you, let's say it's costing you, 3.4% per annum, but you're making cumulatively 15, 20, 30% per annum on that investment, or even more, depending on the compounding cycle, that is a good loan, a beautiful loan, a great loan. You're leveraging debt to make yourself better off. If you use that money to buy a building, you bought a rental property and you're therefore earning from that rental property. So you're paying the mortgage. And when you subtract the mortgage payment and the mortgage interest from the rental income, you have a positive number at the end, a positive cash flow every single month. That is a great investment and a great form of borrowing. If, on the other hand, you have a negative number coming out every month, negative cash flow, and you're hoping for capital appreciation, that might not be so wise. So take a look at that carefully. Milton Brady said, it is essential to invest in decentralized crypto, utility tokens, and so on and so on and so forth. All right, thank you for that, Mr. Brady. Much appreciated. We're going to come to crypto in a bit, though. All right, so borrowing to consume, as I said before, is suicidal. You overpay and you rob your future self of a better life. So you're robbing yourself when you borrow to consume. You can borrow to invest, but you have to ensure that you understand what they call the cost of capital. What is it costing you to borrow relative to the return on the investment? Those who think they are poor often only consume and never save to invest. And that's very bad. No matter how poor you think you are, please get over the habit of just consuming. You need to find a way to save even a small amount. The Community Capital Club says $1,000 or more per month. If you put away $1,000 a month as a poor Jamaican in the Capital Club, for example, and you save $12,000 and you sit in the club for the year, and that money is loaned out to other members of the club, bringing the interest for you, you're better off than if you had just eaten 2 more patties and 2 more box juice, right? So even if you're poor, please get in the habit of saying, I must save something for investing each and every month. Do it weekly if you can, okay? Now, the middle class, unlike the poor that just consumes, or those who think they're poor, so is in most time poverty is a mental thing. You think you're poor, so you behave poor. But if you overcome that mental trap and decide to think rich, Think and Grow Rich. That's a great book by Napoleon Hill. Get it if you haven't and read it. Just think rich, no matter how poor you are. And I can attest to that. I mean, I was born in serious poverty, right? I mean, we lived in a one 12 by 12 room. My mother and the 3 of us lived in this one 12 by 4 room with no indoor bathroom, no separate kitchen, no separate dining, no separate bedroom, just one room. And we were really poor. You look at our meal, poor. But I never accepted it mentally. I always believed in my capacity to overcome poverty, and I did everything possible to do so. So do not think poor, think rich, no matter how poor you are, and then save to invest. Now, middle class people who are in the middle class, meaning they're not rich and they're not poor, and they don't think of themselves as being poor. Maybe they have a decent job, and they're earning a decent income, so they can buy things. They can buy things, they can pay their rent or pay their mortgage, and they can buy nice clothes, and they can, get a loan to buy a car and whatever. So they look cool. These middle class people make one big mistake. They save to buy liabilities. So they save up money to buy things that make them look rich. But those things just keep pulling money out of their pockets. So it's really keeping them poor. It's keeping them from being rich. They look rich because they're able to buy things that the poor are not able to buy. They're able to look the way the poor are not looking. They look richer. And so they buy liabilities. They buy things that takes money from them. They buy cars that they shouldn't buy. The price is too high. The debt is too big and the debt is too long. They buy bigger houses than they need to. And they buy bags, handbags, and clothing that make them look really cool. but they are in fact making sure that they will never be rich, that they will never be financially free, they will never be financially independent. Now, rich people, on the other hand, do a different thing. Rich people buy assets, or people who want to be rich, people who want to be financially free, people who want to be financially secure, they look for assets. So they buy things that will bring them money. So they buy whatever it is, be it stocks or bonds or rental properties or whatever. They keep looking for things to buy that promises to give them a return. So the money that they put out, they're not losing it. So they put out $100,000, they're expecting to get back 110, 120, 200, 300,000, whatever it is. They're investing in things that brings them more money, not things that only make them look rich, but actually keeps them poor by sucking money out of them. So these are basic investment principles that if you miss them, you're going to lose out. I can guarantee you. And the longer you do it, is the more you're losing out, because all that money that should have been compounding for you is gone. Either in a nice, unnecessarily fancy car, beautiful car, great, but it's taking more money out of you every month to pay for that car. You probably could have done with a lesser car, a used car maybe, and not one of those expensive model, and you would have had more money to invest, and that money you invested would be bringing more money to you. So that's a very, very important idea to get settled. Poor people, or people who think poor, spend to consume and they never save to invest. Middle class people buy liabilities that takes monies out of their pocket. A liability is anything which is taking money from you and not bringing you money. An asset is anything which you put money into it and it gives you more money on top of what you put into it, right? So people who want to be rich, or who understand the path to be rich, or who want to be financially free and financially secure, they're going to invest in assets that will bring them money back. Hope that makes sense. Now, here's an interesting comment. If I were advising a young person, today, and this goes for anybody, but particularly a young person trying to make life, most times the young person will want to start a family, and part of that is to get the house and the car thing, right? Maybe you want to build a business before you build a home, and that might sound really painful to some, but if you build a business or build an investment, it doesn't have to be a business that you own fully. For example, you can just decide that you're going to invest in certain kinds of businesses. You're not going to own it, meaning you're not going to be operating it. You're going to be a part owner. Maybe you own 5%, 10%, whatever it is, but you're going to put money first into owning a piece of some businesses, or building a business, a meaningful business, before you build a home. Because remember, the home is really not so much of an asset. It's not going to bring you any money. The home is going to just take money out of you. It's going to take the mortgage. The down payment, first of all, is going to suck out of you, which could have gone into a nice little business and kickstart. It's going to then take the mortgage payments out of you. It's going to take the mortgage interest out of you. And it's going to really rob you of the funds, the limited funds you have to invest in a business. So what will happen is, yes, you'll get the house, you'll pay it off over 30 years or over 25 years, but you have lost the opportunity of 20 to 35 years of an investment. Now, supposing you took that same down payment and put that down payment into a meaningful business, and that could be stocks. It doesn't have to be one that you own and operate. It could be stocks that you buy, or it could be a small business that you create because you have confidence in yourself and you understand that market very well. You invest in it, and it turns over to the point where it's really generating good cash flows for you now. And then you take some of that cash flow out and you use that as a down payment to then buy the house, or to buy the land if you plan to build, or whatever the case may be. And then while you're doing the building and so on, this business is still operating for you and generating. And because you're doing this over time, you're getting better at it, right? So the business is getting better and stronger and more powerful and more cash rich and more stable, and you're expanding and so on. And because of that, now hear what you've just done. You have the best of both worlds. You have a good business or a good portfolio of stocks or whatever other kind of investment you choose, for example, rental properties. You have that going. It is solid while you're now paying for your house that you're now and the nice car that you have now gotten, but you have something paying for it for. So the business is actually paying for the house for you and paying for the car for you while you probably still have your job. And so your job is giving you the income to do whatever you want to do. Your small business is doing what it needs to do, or your portfolio of investment doing what it needs to do. Your house is being paid off, your car is being paid off, and now you have a very good balanced position in your life. I hope that makes sense to you, and you don't think I'm crazy for telling you to build a business before you build your house, But that's some investment ideas for you there. Now, another thing you want to look at is there are three primary kinds of financial investments. You can look at so many different types, but there are three primary types of investment. One is rental property. Another one is interest-bearing instruments. And the third is equity capital. These are primarily the fundamental types of investments that you can make. Lentworth says, how much do I get when I take out a family indemnity plan? How much am I wasting? Well, that is a very interesting question. It depends on the details of that plan and where it fits into your investment life cycle right now, because there are different things to do at different stages of your life, right? That makes sense to you. For example, when a person buys, say, insurance in their younger years to make sure that they're covering the eventuality of if they pass away and their children are going to be exposed, versus how much insurance they buy in their older age when their children are no longer depending on them and are, they've gotten their education, they're working, they're quite fine. So your insurance mix is going to differ. The same thing with any other structure you put in place, any trust or indemnity or insurance or the portfolio mix that you may have, what you put in liquid assets versus longer term assets. All of those things will change over time based on your personal situation, your age, your investment time horizon, and so on, right? It will vary. So back to the main point here, there are three primary kinds of financial investments. And I want to talk to you about the three of them. Some advisors may tell you about many other types, but I kind of see three when I look at investing. And if you understand the three of these, it will help you to make good decisions about your investments, right? Daily Happening says, work to build a business and your business build your home and send you on vacations and give you financial freedom. Absolutely. Excellent way of putting it, Daily Happenings. The problem is, though, if you don't do the previous things I said before, you can't really build a solid business because you would not have invested in yourself to have the competencies and skills you need to do that. So again, there are stages to getting there, right? So, but let's talk about the three types of investments. There are rental property investments, interest-bearing debt instruments, and equity capital from which you get dividend income or capital gains. These investment comes in various shapes and forms, stocks, bonds, real estate, including farmlands, commodities, such as water, energy, food, gold, silver, or some other asset class, such as even crypto or artwork or royalty. These are all different forms of investments. Notice I mentioned something as simple as water, energy, food. Let me tell you something about myself that, you may find useful or not in terms of my investment strategy. And you can tell me if it makes sense to you. But it's something that I thought about and figured out a long time ago and decided to apply it to myself. I decided that one of the best ways to go about investing is to think about, first of all, creating a secure buffer zone in my life. And then beyond the buffer zone, now I can do crazy things if I want, right? So create a buffer zone. So that buffer zone comprises some basic elements for me and my family to be fairly financially secure, financially free. Now, don't get me wrong. A major disaster can wipe out your best of plans. You can have the best of plans, and an earthquake comes, a hurricane comes, a storm, or criminals, or even a change in governance in your country. A country can move from being a peaceful, prosperous, safe space to becoming very unsafe, unpredictable, and the economy just completely drops and mess you up, like what happened during FinSAC in the 1990s. So nothing is foolproof. There's no way to be 100% secure, but you can be more secure than others based on your planning. So in my investment planning, one of the things I wanted to make sure happened was I'm going to make sure that I have water security. So I'm not depending on the government to provide me with water. So I'm going to invest in water harvesting in my own space. First of all, I'm going to buy farmland. So that was one of my investment strategies. Buying farmland so that I have the freedom to do things that you can't do when you're not living in a farming space. Sometimes people live in environments where there's not much you can do in terms of farming, even though there's still opportunities, in creative ways to do some amount of stuff. But in reality, it's kind of hard. So I invested in farmland, first of all. So land is one of the kind of investment that it's not going anywhere. They're not making any new land. So there's a finite amount of land, except if you're in Singapore, where they create more land, actually. But generally speaking, land is finite. So if you invest in land, there's a certain amount of security there, right? Then if you use that land wisely, you can further improve your financial resilience and your financial security. So one of the things I do with mine is water harvesting. So I build large catchments and I catch water and purify it and use it. So I'm off the grid. I don't have to depend on the government. And this is a very valuable resource. Water is extremely valuable. Secondly, I also invest in creating the capacity to produce most of the food that I eat, if not all. I can meet all of my food requirements if I have to, just from my own environment. And then thirdly, I can harvest nature in terms of energy to provide most, if not all, of my energy needs, and in cases of emergencies, all of my energy needs. So that's a form of investment that actually protects you, because everybody has to buy water, everybody has to buy energy, and everybody has to buy food. So if you build into your investment strategy water, energy, and food, that's like, 60%, 70% of your needs. And then if on top of that, your strategy results in you having a mortgage-free home, so you're no longer paying a mortgage or a rent, that's a further buffer zone that you have created for yourself and your family. So your shelter is secured. It's not at risk. No bank has your title. No NHD has your title. You have your title, free and clear. You are harvesting your own water. You're harvesting your own energy. You're harvesting your own food. That is extremely resilient in terms of building a foundation for financial security. You then have the freedom now to make additional investments beyond that because you've done that. Now, if you've built a business first and the business help you to do that, you're in a very enviable position. And I, would strongly suggest that that's a way to go, especially in the way the world is evolving today. Ann Gore says, found out about investments as opposed to savings later in life when I decided to invest in myself. No regrets, just wish I was more aware decades before. Absolutely, Ann. And the good thing is, it's not too late to learn. It's just that we missed opportunities earlier, and now we're going to learn and do things differently to the best of our ability within the time frame that we have left, on this side of life. Another thing I want to talk about is, do not confuse speculation or gambling with investing. Many people engage in speculation and gambling and think they're investing. Investing is based on careful analysis, using relevant data about the supposed asset. So if you're not doing careful analysis, if you're not using reliable data to evaluate what somebody proposes to be an asset, if you're not doing that, you're gambling. Gambling or speculating is based on feelings, emotions, hunches, guesswork, or just imitating others. That is not investing, and that is very high risk. As I said before, your greatest risk in investment is you. The less you know, the more risky you are. The more risky the investment is because you don't know. The more you know and understand the investment, the less the risk. So don't fall prey to gambling and speculation. It may seem very, very lucrative. It may be very exciting. But if you do it, make sure you understand that you are gambling. So if you get burned, you're not devastated because you know that you were gambling. I know a lady who lost about 70,000 US dollars to a speculation here in Jamaica some years ago when they had a Ponzi scheme going on. And she saw other people getting returns on a regular basis, and she got excited. And she took her last, this is her life savings, 70,000 US dollars, and she invested it. Of course, she didn't invest it. She speculated it. She gambled it. And she lost it all, and she lost her mind, and she lost her life. She didn't die, physically right away, but she lost the zest of life. She became mentally insane and just could not cope with life anymore and became quite a burden to her family, So we have to be careful. Do not gamble unless you know. If you want to gamble, that's fine. I mean, that's your choice. But make sure you understand that you're gambling, that you're speculating, you're not investing. So don't fool yourself and say, oh, I'm investing in this. You're only investing if you carefully analyze what it is you're doing and you understand it. You can explain it back to a 7-year-old child in a way that makes sense to them, right? So, little Johnny, I'm going to invest in this restaurant. And here are the reasons why this is a good restaurant to invest in. And you understand it. It makes perfect sense to you because you are knowledgeable on the subject matter and can therefore, evaluate the investment properly. Janet says, whoa, I should have learned this 20 years ago. Same here, and now I can teach my family. Absolutely. And that's the beauty of the UIC, right? We're not here to simply play politics. We're here to unite our people around good governance. We're here to liberate our people from the chains and bondage of bad governance systems. And we're also here to empower our people with true knowledge and true education. Now, Angor says, any suggestions for solar energy? Those companies advertising really let, I'm not sure what you meant on the end there. Be very careful when investing in solar. What I would suggest you do, and is just go and watch a few videos on YouTube about solar systems for your home. Watch a few of them. Don't waste time on the ones that they're too excited or they're trying to sell a specific product. Focus on the one where somebody's just trying to teach you about solar systems and how it works and what you might need for your home, and get that basic understanding of what is going on. What size system do I need for a family of 2 or 3 or 4? How much panels and how many panels, what is a charge controller, what is an inverter, and just have a basic idea. And then you look up the prices for those elements online and see roughly what it is if you were to buy it on Amazon and ship it in or whatever. And then just add up those numbers and you'll get a ballpark for what you should be paying, knowing that, of course, when you import it, it's going to be, the markups and all that. Then when you get a quote, you compare the quote against that and use that as a yardstick to make a decision. There's so much you can do as a person, right? If you just invest a little bit of time to inform yourself, then you can make good decisions on that. All right. And if push comes to shove, send an email to info@uicjamaica.com. Send the estimate to us and ask us what we think, and we'll just give you a quick feedback on the subject. All right, so you can feel confident about your purchase decision. Yeah. So as I was saying before, don't speculate or gamble unless you really mean to, and don't confuse speculating and gambling with investing. Now, to invest wisely, you need to fully understand the asset class or the business and the industry or market in which it exists. So what I mean by this is, whatever you're going to invest in, do some research about that class of asset. Let's say you want to do rental properties. Do a little reading on the rental property business, and then get some information about rental properties in the area that you're looking at, and then the math is very basic. It's not complex math. You want to look at how much you're putting down for the house, what will be the mortgage for that house, what will be the mortgage payment, how much can you rent it for, the difference in the amount you're getting from the rent and your total costs, your monthly costs, your costs for repairs and maintenance estimated, your cost for property taxes estimated, divided up over the 12 months to get a good feel for that, and your cost of actually, dealing with tenants, and all of that. And just do the math, the basic math, and then come to a conclusion if this is good for you. The same for any business. You're going to have to spend a little bit of time understanding the business, understanding the product, understanding the investment before you jump into it. You must also study the fundamentals of money versus currency. We did that last week, and we'll do some more in coming weeks. Because if you ever forget the difference between the two, you're going to make some mistakes. You want to learn a little bit about accounting. You're going to need that to be able to read financial statements. We're going to go over that here in future discussions. I'm going to teach you the basics of accounting, how to evaluate an income statement. And an income statement is very simple, no matter how complex they put it on the charts. An income statement is fairly simple, right? An income statement has 3 parts: income, expenses, and profit. Income minus expenses is profits. Now, if you look at any Fortune 500 company, the income statement is going to look a lot more complex than that. It's going to be like really full of lines and all. It's not that critical. The key thing is for you to be able to identify what is the income for this company here, how much is it making, and you look and always look at trends over the last 5 years, is the income going up or is the income going down over the 5 years, right? Then you can look and see where is the income coming from. So for example, is it sales of products, or is it something less consistent or less durable or less repeatable? For example, they might have some interest income or something like that. Then look at the expenses. What are they spending money on? And the trend. Is the expenses going up while the income is coming down? Or is the expenses going up in tandem with the income? Or is the expenses climbing slower than the income is climbing? If the income is climbing, but the expense while climbing is climbing at a lower rate than the income, that's a good sign. If the income is climbing, but the expenses are climbing at a higher rate than the income is climbing, that's a bad sign. Then you look at profits. Now, companies do tricky things to avoid showing too much profit. So the profit is one thing. Then you want to look at what have they used to reduce the profit of that business, and is this a strategy versus an inefficiency? If the company is inefficient, meaning they're just bulky, too much cost for what they do, that's bad. But if they're being strategic, for example, putting back money into R&D and claiming a lot of amortization or depreciation against assets that they bought to improve the quality of earnings in the future, then that's good. That's strategic. So you want to be able to read the financial statements, the income statement, to understand that. The balance sheet is the second statement you want to understand. The balance sheet is different. While the income statement tells you what happened for 1 year, from, for example, January to December, and you might see a 5-year history which showed you what happened in each of the last 5 years to show you a trend. The balance sheet, on the other hand, is telling you what has happened over time. From the beginning of time to now, how is this company performing? You're going to see assets at the top. You're going to see liabilities, and you're going to see net worth, right? Those three segments, you might see many other lines in between, but those three segments are telling you something. Asset is a very important line. It tells you how much does the company have in income producing things, trucks, machinery, buildings that are being used to produce. Those are the assets. Inventory, those are the assets. Then you want to look at liabilities, because liabilities tells you how much debt has the company taken on, how much outstanding liability it has that is a claim against those assets. So let's say the company had, $50 million in assets and $25 million in liabilities. It means that, they have far more assets and liabilities, twice as much assets than liabilities. And then when you subtract the liabilities from the assets, what you have left is the equity in the business, the net worth. If it's a big number, that's great. If it's a small number, but the company is growing, and so they've taken on a lot of debt to make that growth happen, and the story behind that company makes sense to you, you can invest in it, right? So you want to be able to read the balance sheet properly and understand, what is this telling me? What is the story here? And again, you want to look at trends. The last 5 years, for example, how have those different elements changed for the company? Is it cash rich? Is cash a big portion of its asset, or is cash puny, very, very small? A small amount of cash may be a good thing. They're efficiently using their cash, or it could be a bad thing. They don't have enough cash on hand to meet future payments that are coming up based on the current portion of their liabilities. So we have to understand those elements to judge the soundness of that company before we invest in it. Okay? The equity side of the equation now, the net difference between assets and liability, tells you how much the company has to pay out in dividends, for example. and how is it growing, and have room to take on new investment to further improve the company. So we've just talked about two statements, and I'm going to have later lessons on these. I'm just giving you a high level. So you've heard about the income statement, which tells you what happened for 1 year period. And we've talked about the balance sheet, which tells you the story over the lifetime of the company. And then a third statement now is the cash flow statement. This statement tells you where is cash coming from and where is cash going. Because you see, the income statement is not about cash, it's about income. You can make $1 million, but you don't get all that in cash right away. You may have earned $1 million, but you only collected, let's say, $500,000 in cash, and the rest is a receivable. Somebody owe you that money. A company with a large receivable, and that receivable is aged, meaning it's they're not collecting money fast enough, may have a cash problem and cannot meet its regular expenses, and must borrow short term to meet those expenditures. And for that, that company will have higher interest costs and is not operating at the level of efficiency that would make you happy and comfortable. So the cash flow statement, which to me is the most important of the three, in fact, they're all important, you must read them together. But the cash flow statement, which most people don't really look at, tells you what's really happening. Where is cash coming from? Is it from operation? Is it from financing? Is it from equity injection? And where is the cash going? Is most of the cash paying back interest? Or is the cash going into dividends to reward shareholders? Or is the cash going into capital investment and research and development to expand the company and make it even more wealthy? So these are critical things to look for when you're evaluating a company to decide if you want to invest in it. It's the same set of rules for a big blue chip stock company as it is for a small mom and pop store on the corner. You want to look for the same thing. The problem is, for most small businesses, they don't do good accounting or good bookkeeping and may not have good reporting. And so you have to be very careful of those, right? You have to know, can I trust the reports I'm getting? Are these in-house reports, meaning produced by, the small business owners themselves, and they make up some figures and show you? Or is it audited? Or if not audited, you have reasons to believe it's reliable based on other factors that you have seen, right? So, you have to look at all of those things and make sure before you do your investing in any business or company. So to invest wisely, you need to fully understand the asset class or the business and the industry and the market in which it exists. You must also study the fundamentals of money and currency, accounting, finance, economics, law, markets or people and politics. If you don't, you'll be gambling, not investing. I've just run off of a list there a while again of finance, economics, law, markets, and people. I'm not talking about you going to get a degree. I'm talking about you just getting enough knowledge, basic knowledge, so that you can understand the story of the company. So you want to know a little bit of economics, a little bit about, law, a bit about markets. When you're doing investing, markets is critical. So you need to understand people and markets and understand the politics and culture in which you're doing the investing. If you don't pay attention to those key, the people dynamics, the politics, and the culture, you will make dumb decisions. If you stay in the USA and try to invest in Jamaica without understanding the markets here, the people here, the politics here, the culture here, you're bound to make mistakes. And that's why sometimes you find Jamaicans coming back home from abroad. They have lived away for 20 years, 30 years. They do not understand the local context, and they come back here and they make some really bad decisions, and oftentimes have to pack up and go back to the UK or to the US or Canada because they have been robbed here, right? They didn't understand the markets and the people and the culture because they've been away from it for so long. When my wife and I came back here, my family, we came back here in 2011, we had a plan. And a part of that plan was to make sure that we spent the first couple of years just reacclimatizing. We come back here, we didn't spend all over the place, we didn't do anything fantastic. I came back here and actually took a job and just to learn the culture again and learn and just fit in and learn what's going on the ground before making any major moves. So if you saw us in the first couple of years, we actually look poor. we look, we're just ordinary. We're not doing anything, grand. It just looks so simple and so basic. And we spend those first 2 years to just fully re-engage with the marketplace, re-engage with the market, re-engage with the culture, and getting that understanding and feeling for things. All right. So now let's talk about Bitcoin. Now I've spoken about general investing and things to consider and so on. Let's talk about Bitcoin. Cryptocurrencies. That's a big thing right now, big deal. Going around. People are really, really excited, really crazy about getting into the crypto space, and there are lots and lots of money being made, and right now crypto is heading up to 100,000, and people are really excited. And you might feel you're losing out because you're not investing in Bitcoin or crypto, but here's the thing: you don't understand it. Maybe some people I'm sure understand it that are on this live here, but some of you don't understand it at all, and you are wondering, how does this thing work? What do I do with it? Well, first of all, let me just explain that Bitcoin is not money, and it's not currency. It's not digital money, and it's not a digital currency. Why? Because it lacks the characteristics of both money and currency. Remember, money needs to be a unit of exchange, a unit of measure. It needs to retain its value. It needs to be, relatively easily accessible and is used in the normal course of trade and so on. Bitcoin isn't used for any of that. Bitcoin is said to be an asset class. But it is but that is also questionable, whether it's an asset class or not. What is an asset? An asset puts money into your pocket. A liability takes money out of it. And I'm using simple terms. I'm not using accounting terminology. It's more complex when you try to use, what they teach me in school about defining assets and liabilities. So I'm more a Robert Kiyosaki kind of guy when it comes on to talking about these things. So an asset, basically, it brings you money, and a liability takes money out of your pocket, right? So Bitcoin right now, as far as people are concerned, when they buy it, the value generally is going up. It has gone up and down, but generally it is going up. And so for them, that is a beautiful thing. And of course, it is a beautiful thing. But for them, that is what makes it an investment and an asset. But a real asset class is one that has some kind of underlying value proposition that is going to give you a return on your investment from that value proposition. So Bitcoin and crypto is a brilliant idea that resembles a Ponzi scheme and the tulip bulb bubble of the 1600s. A Ponzi scheme is one where the value of the asset keeps going up because more people are pouring into it, not because of any particular value proposition. Now, there is a value proposition I'm going to talk about in a bit, which could be, alternative to what I'm saying. But a Ponzi scheme depends on what we call the greater fool theory. This is where you need more fools coming into the pie or to the pile for the value to keep going up. And the moment you get to that place where there are no more fools to come in, it deflates, and those who get caught holding the bag loses everything. right? So there's no doubt that some people will make lots of money from this scheme, while others will lose a lot as well. It's a zero-sum game, meaning at the end of the day, you're going to have some big winners and some big losers. So it's not necessarily an asset, it's more something like a gamble. So the trick here is to buy low and sell high and not miss either the low or the high. So those who miss the low, and the longer you miss the low is the more you're buying high. And those who sell late, they're missing the high in terms of selling. So this is really a gamble. There's no use case yet for Bitcoin, meaning where do you use it? How does it actually benefit you, except if you're using it like gold as a edge against inflation, and based on the logic that Bitcoin has the characteristics similar to gold, but it's not gold, but the characteristic of there's a limited supply of it, and it can be used as a store of value, while the value of your currency is not dependable, then it could approximate gold. The only thing is it's not gold, it's not physical, it's digital, and there are some other issues here. So Bitcoin has no intrinsic value except the promise of being a protection against inflation created by bad governance. That's really all it's doing here. It's promising you that if you put money into this, your money, the value that you're transferring into this, will be protected against the inflation created by bad governance. And there is a real inflation risk, a serious risk, and we've just tasted some of it recently, of even hyperinflation, where the money that we have is going to lose its value so fast, like in Argentina, that it's not worth holding on to this so-called money or currency. And so Bitcoin is a value proposition that says you can use this to protect yourself from that. Now, here's the flip side. Unfortunately, government can outlaw it at any time, like was done in China. So even though you may use it for that purpose, overnight, your government could just say, we're outlawing this, and make you a criminal for owning it. So if you don't get rid of it, you are now a criminal. And you know the government, they can use the law against you in powerful ways, right? Yeah. Now, any gain, let's say they don't outlaw it, they can also tax it away, which they're doing in the US now. And if the Biden-Harris team had won, for example, that tax could be very high, which makes the value to you much less, right? Of course, Trump appears to be more amenable, more friendly towards it, so that could really cause the value to go up even higher. So maybe if you gamble now and jump in at near 100, you may ride a high that goes up to 200 and double your money in no time. Possible. Okay. However, it may also fall to zero when the big players start to sell. It's called pump and dump. So right now they pump you, they prime you, they tell you all the good news and cause all the good news to come and all the suggestion of look. And so far the trend is really enticing. And so you feel like, hey, this is really good. I need to jump in it now before I lose this opportunity. And guess what? You jump in just at the time when it's going to be deflated and you lose everything. As I said before, it's a zero-sum game. So there will be big winners and big losers. But as I explained before, you need to understand the difference between gambling and investing. Right now, many people are gambling because they don't understand what they're doing. There's some who may very well be investing because they do understand what's happening and they're playing a game and they're a part of the game that will do, for example, a pump and then a dump. So if they can pump us up and get more fools to come in, and so they have bought, let's say they bought into Bitcoin when it was 50, and they're going to ramp up the rhetoric and ramp up the advertising and ramp up the campaign and say, push, 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 let's get to 100. Let's get to 200. And then they will sell and create an avalanche, and then the price goes down, to 75, 60, 50, 30, 0. And by the time the large majority of novice investors, gamblers, understand what is happening to them, they have lost their life savings to another Ponzi scheme, another trick. So please be very careful with that. Monica Richards said, when I returned to Jamaica, that was where I first understood who I am. Heavy slavery experience was very visible. And Angor says, Nathaniel, just Google petition Joseph Patterson. And Monica says, how does Bitcoin deplete? How does Bitcoin deplete? I'm not too sure what the question means, Monica, but let me try to give some kind of an answer, right? Bitcoin, the value of Bitcoin is based on what people expect to happen. It's just like fiat currency. Fiat currency exists as long as we believe in it. When we lose faith in it, it becomes no longer valuable. Gold, on the other hand, for example, you can lose faith in gold all you want. Gold is still gold. Silver is still silver. A house is still a house. A business is still a business. If you don't like it, or somebody else might like it, as long as the business is operating, it's still there. But cryptocurrencies, Bitcoin, is really, as they call it, a digital asset. And again, they're using the word asset carelessly, right? So you want to be careful about how you use the word asset. If it's not putting money in your pocket, it's not an asset. Again, a person can use Bitcoin strategically to say they're going to edge against inflation. They're going to speculate about where it's going. There's hardly any data to go on. There's no data except the trend of it going up or down. And you can link that trend to various behaviors. A president is elected, a certain influencer says something, a particular country passes a new law, and those are the kind of things that people are making decisions on. There's no underlying substantive business case underlying Bitcoin and other crypto. There's no business case there. There's no product being sold. For example, an iPhone is an iPhone, right? That's a product that you're going to use. There are new ones coming out. They have various features. People love to communicate. It's a vital part of our lives now. So an iPhone is a product you can evaluate based on a lot of business analytics. But Bitcoin has very little to go on in terms of business analytics. It's just right now a craze, a sentiment, just like the tulip mania of the 1600s in Netherlands, where a tulip bulb was being sold for the cost of a house. That's a little flowers, yeah? So people can do really crazy things sometime, and so on. So anyways, we move on. So we in the UIC, we have established the Community Capital Club to help our members build their own bank and asset class using the principles of group economics. This is like partner, but much better. You join a group of 12, you lend $1,000 or more to the group each month. This is your group, you're in it, you're seeing what's going on. And then you borrow from that revolving fund to produce something productive. You're lending to yourselves for different things, like buying more inventory for a small or micro business, or even investing in stocks. You pay interest on the loans you take out, and you earn a proportional share of the interest collected on the loans issued to the members of your club. So everyone wins. So here you are in an environment where you have 12 or 13 of you, pooling your resources in a controlled environment with very careful rules and regulations, but which allows you as a team to make decisions on lending to yourselves and turning over that capital. So more and more you're building because you're saving to invest, You are investing among yourselves by lending to each other for whatever you want to do that makes sense to the group. You're collecting a return on this. It's increasing the pie. And whatever return is being collected is being reallocated back to you, the members. A beautiful system. So the UIC Community Capital Club is an automatic saving and investing vehicle for our members to grow their wealth faster. The club members help each other to stay accountable. And together they're reducing the risk of loss, of losing their capital, because they are working with each other. They know exactly who they're lending to, and they have repeat business experience, and they have full insights into those they're lending to, because they're lending to themselves. So that the risk of losing capital is extremely reduced. This is a great way to stay ahead of inflation, actually, because you're using one of the three asset class. In this case, you're using interest-bearing debt instruments, but you're using it in a closed loop with a narrow set of persons, which allows you to have full insight into what is happening. So every week, we'll continue to learn more about money, about accounting, about economics, about finance, about business, while building your capital base in the club faster and safer than some other riskier options. You don't have to join the UIC or our club to learn what we teach, because this is offered free here. But the club members now get to apply what they're learning here in their clubs, and it's very transparent because they're always doing it together, and the financials are pretty transparent to all the members in the club. So if you join the UIC, and if you join the Capital Club, it's actually a sweet deal for you, because you're getting not only the insights, but an opportunity to build and grow in a relatively safe space. So one last point before I go, and this is very, very important. I mentioned a little bit of it earlier on, that build your plan, whatever plan you're building for your life, whatever financial plan you're building for your life. Be secure before you take on any bigger risk. So secure your health. Make sure that a part of your plan, and the first part of your plan actually, is to secure your health, because without health, nothing else matters. So I always encourage people, when you're thinking about becoming an investor, why not invest first in yourself, in your health, making sure that you're eating right, sleeping right, thinking right, and doing righteous things in your life. Yeah. And secure your home. Make sure that whatever plan you're involved in, you're figuring out how to secure where you live, so that, or where you want to live. You might have a transition plan, but secure a space and do it smart. For example, if you're coming back home to Jamaica, let's say you're overseas and you're planning to return to Jamaica, design your plan to make sure that you build in increment. If you're build a complete piece of your home first, so you have somewhere to sleep comfortably, to bathe comfortably, to eat comfortably, to cook comfortably. Sometimes our people are so they put their hat too far, so they have grand plan, delusion of grandeur. So they design a sketch for a 3-story building with some really ornate spaces in their homes and so on. And then, you just see all these buildings littering the landscape, unfinished. Most of us die before we finish them. Why not build something smaller? You may even design a plan, if you will, design a plan that is bigger if you want, but build something smaller and affordable and practical. Build it knowing that your kids may never come to live with you. They're adults now, they have their own lives. So building a home as if you're, going to be 35 or 45 forever, and that you're going to have the kids living with you, is not very wise. And don't build a home for the entire family to come home and stay with you, because they're not. And if they come, they're coming for a short time, and you're going to be left with the cost for a very long time, right? So build with practical things in mind, and build your home understanding that you will grow old. So build your home to facilitate aging. Don't build your home for a 35 or 45-year-old. Build your home knowing that you're going to be in there for the long haul. You're going to be there when you're 60 or 70 or, so not too many stairs maybe, and make the bathrooms accessible, wheelchair accessible, and so on. Just think about these things, right? And plan for them. So plan wisely and build wisely so that you can, so secure your health, secure your home. If you wish, you want to do like what I do, build in a way to secure your water, your energy, your food, so that no matter what happens, your basics are uncompromised. Your bread and your water are sure, your shelter and your energy are sure. And if you have no mortgage, no rent or car payments, and your water, food, and energy needs are secure, you are in a very good position. You can now even invest broader and wider and take on what people might say are more risk. I don't talk about taking on more risk. I talk about taking on bigger challenges. So because risk is always about you. How risky are you? And you can mitigate those risks by simply being more knowledgeable. Yeah. And we're here to help you gain that knowledge. So that's it for tonight. Let's get your quick feedback. If you found this to be very, very useful, give me a rating, 100% if it was very good, 50% if it's so-so, 0 if it was not very useful, just so I can get a feedback to know how you found this session. Drop a question or a comment or a feedback as well, if you like, down below, and let us know. Milton Brady says Bitcoin is only one asset class in the blockchain, not very useful, but there are many other crypto technologies that will be driving the fourth industrial revolution. Very well said, Mr. Brady. And maybe one day you can come on and share with us some of that so we can learn more from you. And Gore says, speaking from experience, size means money to them. They're what nervous breakdown are made of. Absolutely. My wife and I decide not to build very big because we love to live life. So we focus on building what is useful, tasteful and all of that, but focusing on how do we then get to live a good life and invest in other things. Like I put a lot of our investment in the UIC. Now that's a non-profit investment, but that's my investment and contribution to Jamaica, giving back with the hope that it will be a better place for my children and grandchildren and yours. So I've invested in that without an expectation of financial return. What I will get from that is the return of peace of mind that, I have done the best I can to help my country to be, hopefully my personal goal is for Jamaica to be no less than Singapore. That's my intentions. It's a long, tedious, difficult, maybe even impossible journey, but I'm doing the best I can to see if I can help us to get there. So once again, thanks to all of you for being on tonight. Really appreciate it. I'm being reminded that I need to share with you this very important thing. So let's do that.
Hi everyone, this is Charlotte, and I hope you're doing great. I'm just stopping by to say hello and to remind you that UIC's annual Christmas fundraising banquet will be December 14th, 2024, starting at 5 p.m. This year, our location will be Summit Kingston, formerly called Knutsford Court Hotel, which is at 11 Ruthven Road, Kingston 10. As you may know, UIC Jamaica is 100% committed to good governance and aims to unite, liberate, and empower our people. If you desire to see Jamaica become the paradise it should be, clean, safe, beautiful and orderly. Then, your contribution of 10,000 Jamaican dollars or 65 US per adult and 5,000 Jamaican dollars or 35 US per child will help us to provide a new leadership, a new system for a new Jamaica. We promise an evening with lots of fun, lively entertainment, great speeches, and delicious food. While it would be my greatest desire to see you all in person, I know some may not make it home for Christmas, but your donation will give someone less fortunate the opportunity to attend. Thank you so much for taking part in helping us to educate and work with our citizens to restore and in some cases rebuild our beautiful country. Here are your options to purchase your ticket. You can go to www.uicjamaica.com and pay online, or you can send payment via Western Union, MoneyGram, Zelle, Cash App, or bank transfer. Call 876-293-0812 for additional information. To RSVP, you can email us at info@uicjamaica.com, or you can WhatsApp us at 876-293-0812. Thanks a million for making this possible. One Jamaica, stronger together. Hi everyone.
So here we go. Well, I hope you enjoyed that, and I hope you'll get your tickets or donate if you can't come, right? Donate to it as well. And I want to comment though briefly on a feedback here from Mr. Milton Brady. He says, Mr. Patterson, you should really do more research on crypto technology before you speak on the subject. Well, it may seem as if to you, it may seem that I haven't done my research on the topic. So what you can do, I'm inviting you on. So let me know when you can come on and we can have a discussion on the topic. So if you're available for next week, let me know, and we'll have Mr. Brady on, and he'll be able to highlight the gaps in my understanding and to explain to you what he knows that I don't know. I have taken the time to look into crypto very, very carefully, actually, because I would be very irresponsible to speak on the subject without. Now, I may not say what others say about crypto, and that's where you might have a gap. Like I may not, promote it or suggest it or say whatever. So let's have, other people come on. Anybody who wants to come on to the show and talk about finance, investing, the Community Capital Club, please just contact us at the numbers here, 876-293-0812 or info@uicjamaica.com, and we'll be happy to host you so that we can, get your views out there. And I will challenge you, by the way, as much as I expect you to challenge me. And I have every confidence that our listeners will benefit from such an exchange. But my views on crypto and Bitcoin are very, very solid. It doesn't mean that I am right, but it doesn't mean I haven't researched it. And it doesn't mean that you should not choose to invest in Bitcoin or crypto, but I want to encourage you to make sure that you are in fact investing and not just gambling or speculating, because that can be quite heartbreaking if you don't take the time to fully understand the space, the asset class as it is called, and then be very informed when you make your decision. Mr. Brady said, I agree that Bitcoin is purely speculative, but the blockchain is a lot more than just, oh yes, now the blockchain is a technology, and that's a different matter. I'm talking about investing in Bitcoin or crypto. So Mr. Brady is amending his statement. He's saying that Bitcoin is indeed purely speculative, but the blockchain is a lot more. So tonight I was not talking about the blockchain. I was talking about Bitcoin and similar cryptocurrencies. And I'm saying that, be careful, right, what you're doing. And you can make a lot of money from any speculation. For example, if you were a betting person, you could have betted on the recent US elections. You could have betted on Biden versus Harris, and it's gambling. And based on the odds and whatever, you could have made some money if you want to make money that way. I do not, as a person, I do not engage in gambling. I have seen what it has done to others, including family members. So I don't gamble. I prefer to invest. And when you invest, sometimes you don't make as much money as some people, but you also don't lose as much money as some people. And investment is not my first career choice. So some people, for example, like Warren Buffett, has made a profession out of investing. So you're going to spend every waking day doing that. My investment is a bit broader. So I invest in things like my health, my understanding of the world and the economy, my understanding of politics and governance. So I invest more time than other people, for example, in studying governance structures and systems and what work. So when you do that, it means you're going to reduce the amount of investment you're going to make in financial investments, because you need time for all of them, right? So if I'm doing something else, my asset appreciation, which might just mean my mind and my capacity to think and reason in some spaces, will be higher than others, while my monetary gains may not be as high as somebody who specializes in the other area. But it doesn't mean that I cannot now speak on the topic, because I would have done the research. For me personally, I am one of the more fortunate Jamaicans, meaning that I've made choices in the past which gives me a stronger financial foundation than most. And it did not come by chance. It wasn't a gamble. It wasn't by accident. It would have been because at an early age, I choose to do some things. For example, even in my own health choices, I chose to make certain choices, which today, at my age now, I am better off for it because I made those choices 30 years ago, 35 years ago. And so now I benefit from that. The same for you. The choices you have made in the last 20, 15, 30 years, you're reaping the benefits of those right now as well, or the consequences, because life is about rewards and consequences. We're rewarded for the good choices we make, and we're punished for the bad choices that we make. And my goal is to help us make more good choices, and this is one way we can do that. So once again, thank you all for being here tonight. It has been an absolute pleasure chatting with you. And next week, Friday, I will have another treat for you on the subject of how we can achieve financial freedom or financial security in a very insecure and increasingly unfree world. Have a good night until next week. One Jamaica, stronger together. Take care.